openly talking about what sustainable investing means is really important. And at the end of the day, it's a question of what do the ultimate beneficiaries and asset owners want. And I think we need to have a much, much more open and nuanced discussion about the fact that there are many investors, asset owners out there who not necessarily want to have an investment mandate that specifically talks about sustainable impact or positive societal or environmental outcomes. And I think getting to grips with what the sustainability preferences of your investors and your clients actually are is incredibly important. And I'm to that extent also glad to see that parts of the regulation are moving into that direction, whereby investors are actually required to ask their ultimate beneficiaries and clients as to what sustainability preferences they really have.
I'm Aoife Devitt, and welcome to the 50Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. This podcast series is kindly supported by Franklin Templeton and Alvine Capital. Franklin Templeton is a global investment management firm that provides a broad range of investment solutions, including mutual funds, ETFs, alternative investments, wealth management, and technology-enabled financial services. Founded in 1947, the firm manages approximately $1.8 trillion in assets under management and serves individual and institutional investors across more than 150 countries. Alvine Capital was founded in 2005. It's European-focused private capital advisory and placement agent that provides capital raising services to investment managers from its bases in London and Stockholm. It creates bespoke capital raising programs that blend appropriate investor targeting and sophisticated marketing to deliver a fundraise aligned with institutional expectations. I'm joined today by Dr. Michael Viehs, who is a globally recognized expert on responsible investment, stewardship, and long-term value creation with over 20 years of experience in practice and academic life. He has advised leading institutional investors on a combined asset base worth more than $4 trillion and currently blends a combination of academic and advisory roles. Welcome, Michael. Thanks for joining me today.
Thank you, Aoife, for having me.
Well, we met when we both worked at Federated Hermes in London, and we were on slightly different sides, adjacent sides of the business, I suppose. But I'd love to have you talk us through your background and how you entered sustainable investing ultimately, and whether there were any surprising turns along that path.
Yeah, thank you, Aoife, for this very nice introduction and also for this introductory question. I tend to answer this question always with one word: coincidence. I didn't plan to actually work in either investment banking, asset management, or, for what it's worth, sustainable investing. I did my master's program in the Netherlands at the Maastricht University and focused on corporate finance. And back then, when I was writing my master thesis, actually, I had a little bit of a touch point already with what we call nowadays shareholder activism, shareholder engagement, in the broadest sense, part of the responsible investment theme nowadays. And what happened actually that my master thesis supervisor actually asked me at the end of my stint at Maastricht whether I wanted to actually turn this master thesis into a chapter for a PhD. And he said, yeah, we have a new data set on shareholder engagement, shareholder activism. Why don't you actually kind of start working on this theme if you're interested? And I had to think about it a little bit because it was never my plan actually to become an academic or do a PhD in corporate finance. But in 2009, then I actually did it and went for it. And it was a pure coincidence because someone who I'm lucky enough to call nowadays my mentor actually had trust in me and put the faith in me that I can actually achieve a PhD and also do a lot of academic research in this field. So by pure coincidence, actually, I obtained this academic credential, which then turned with a stint at the University in Oxford, which then led me to where we met at Federated Hermes back in the day, where I then started putting my theoretical knowledge that I had acquired during my PhD studies into practice by first doing shareholder engagement myself with German-based companies, and then later on actually focusing on the ESG integration activities with portfolio managers and investment teams. And this was a journey that was really also a very steep learning curve for me because, and I think we turn to that question later on as well, I think I was really in a very, very privileged position to effectively turn my theoretical knowledge into practice and help portfolio managers think about wider topics other than only financial metrics. Back in the day, we called them ESG factors, environmental, social, and governance factors, and help them make better long-term investment decisions. But effectively, I was not being German by birth. I was not following this traditional German pathway of doing your A levels, studying, and then have everything planned out in terms of where your career is going to go. It was a pure coincidence that I ended up in London nowadays, where I have the opportunity to work on these topics.
And I'd love to ask you before we go into your current focus in academia today, just in terms of obviously a PhD takes a long time and the research goes quite deep. This is also an area that's changing fairly rapidly and even continuing to change with AI and the visibility that may give into metrics. Much of what you did in your PhD was changing as you go. And how much of your subject matter has changed now?
I think it's traditionally or being in the position to be a more quantitative oriented researcher and having done a PhD, which was more focused on empirical research and quantitative metrics and quantitative methods, there was always this element of, I would call, big data and also big data analysis actually in the background. I think nowadays what researchers of the new generation or the current generation are really benefiting from is that you have these tools available that are actually handling and able to handle much, much larger data sets that we were actually analyzing back in the day. I think it's beneficial for this current generation actually to make use of these tools to help them actually kind of arrive at more informative conclusions that are then also be able turned into kind of actionable insights, because I think this is an important bit where the industry, the financial services industry, can learn a lot from academia, namely putting all these conclusions and insights into actions effectively and also turn these insights into investment decisions.
And if you were to characterize your core investment beliefs, maybe as they relate to responsible investing, what is that Michael's creed in this respect, if anyone were to ask?
I never have characterized myself as a specific type of investor or characterized myself as value or growth or momentum or anything of these kind of factors that we all know. I think when it comes to responsible or sustainable investing, what I have adopted is a very, very long-term investment philosophy. And I think no matter how we are defining sustainable or responsible investing, and I appreciate there's still a lot of uncertainty and also discussion around in the marketplace in terms of what these concepts are, I think it's really, really important to realize that whatever you do in this space, it has to do with generating long-term value for most of the time beneficiaries that have a very long investment horizon. And I'm speaking here about insurance companies, but predominantly also pension funds whose money we are actually investing for long-term value generation. And in that regard, I think there's a nice bridge and a nice interconnectedness between the investment world and also sustainability, whereby we can make investment decisions for the long term. So I would really characterize myself as being a long-term investor.
And what would you say you took from your time in academia into the practical world, and maybe vice versa, since you have come back and forth from one to the other? Do you think that makes, first of all, the latter move maybe makes you a more pragmatic, commercially minded academic, and anything going the other way?
I think you hit the nail on the head there. I think having seen both sides puts me into an advantageous position in the sense that I can understand the limits of both academia, but also the industry. So what I think is really, really important is that both sides can definitely learn from one another. Research gets informed by the financial services industry, and likewise, the financial services industry, as I said before, can also learn from academia. But what I think is really, really important is also to understand the limits of both. The industry, how the industry works, is a very, very important kind of question and issue that I think a lot of academics still need to understand in order to focus and make their research even more valuable for society. But equally also practitioners need to understand what the limits of the different conclusions are that academics draw. And I was always a friend of really adopting a research-based or evidence-based approach to sustainable investing. Of course, this has evolved over time. In the beginning, we as academics focus really on this buzzword of ESG, environmental, social, and governance characteristics, and trying to find whether there are any kind of relationships or correlations with financial performance of companies, because it was a very new investment factor, what I would call. And I think this has changed a lot, not only how I approach research and also investing, but also how the general academic world has evolved in that regard. So I think the question of whether ESG, and I don't want to go into a rabbit hole here already, because I think that would be beyond the scope of this conversation. But I think the question that we ask as researchers in the beginning, whether there is a financial benefit from environmental, social, and governance characteristics, is actually not the right question to ask anymore. I think it's more of how we as a society and also how we as a financial services industry, should our clients and asset owners actually want that, how can we effectively generate long-term investment returns whilst at the same time also creating a sustainable societal or environmental impact. So I think I've seen this evolution in terms of what kind of academic research focused on, and then how kind of the industry then at the end of the day also tried to implement those research findings. And one anecdote that stuck really, really with me was, I think it was my very, very first day in the industry after probably 10, 12 years in academia. And I was very proud to actually be invited to present to the portfolio managers my research on shareholder engagement and responsible investment. And one specific question from one of the portfolio managers in the room, a very, very smart investor, at the end of the day asked me, okay, this is all very interesting and it's all very powerful research that I have done and that we see in the wider space. But how at the end of the day can I use this information to make return? And I think this is oftentimes still the question that is today often forgotten when we are approaching responsible or sustainable investing in the financial services industry. And I think this is a question that really stuck with me. And thinking about really, if you want to have an impact in financial services as a researcher, think about what's the value add that you can deliver for portfolio managers and as the ultimate investors at the end of the day.
Well, that's a really interesting but subtle pivot, as you mentioned, away from ESG as a label into full integration. And I think you mentioned something important at the beginning, which is if the clients want it. So it wasn't if it was a mandation, which may or may not happen in, say, a public organization. But how would you characterize then how thinking about these factors can contribute to a return? Is it risk management, just having a broader application of these to risk management and eliminating risks this way? Is it through efficiency?
Yeah, so I think when we focus on the concept of ESG and these three factors, I think they have really turned into a risk management exercise, but also at the same time identifying potential growth opportunities. I think that these factors have turned into an investment factor, like, for example, value or growth, or like other financial metrics at the end of the day. They are not necessarily, and I see this still, they're still being mixed up a lot with impact investing or sustainable outcomes, for example. But at the end of the day, these ESG factors, what we have seen over the last 20 years or so, is that they have been started to become an input factor into the investment decision at the end of the day. And we have come a long way, I think, in terms of integrating those factors into the investment decision making. Most portfolio managers I've worked with in my career to date, even those who are not running a specific ESG or sustainable mandate, they are nowadays looking at clearly governance features of the companies that they want to invest, or they assess supply chain vulnerabilities, for example, of consumer goods companies or the climate transition plans of carbon intensive companies. So these factors are nowadays oftentimes integrated into the investment decision making by most long-term investors, I would say, but they're not necessarily called these days anymore a sustainability or ESG factor, because I truly believe they have found their way into the investment decision-making world. And I think we still have this language problem in the industry. I've now taken a little bit of a step back from financial services, taking a little bit of some time out. And after 8 months of still from afar actually following the news flow or LinkedIn posts on what ESG stands for, what sustainable investing stands for, I think we are still having this big language problem that we are still not able to properly distinguish between ESG on the one hand as an investment input factor for risk management and opportunities identification, but also then that we do not distinguish this properly from sustainable investing, namely also trying to generate a sustainable positive impact or outcome, which can sometimes actually lead to concessionary returns. If you're an investor who actually has in the mandate also that you want to actually generate a sustainable outcome on society or the environment, this might oftentimes be then a trade-off with financial returns. And I think openly talking about what sustainable investing means is really important. And at the end of the day, it's a question of what do the ultimate beneficiaries and asset owners want. And I think we need to have a much more open and nuanced discussion about the fact that there are many investors, asset owners out there who not necessarily want to have an investment mandate that specifically talks about sustainable impact or positive societal or environmental outcomes. And I think getting to grips with what the sustainability preferences of your investors and your clients actually are is incredibly important. And I'm to that extent also glad to see that parts of the regulation are moving into that direction, whereby investors are actually required to ask their ultimate beneficiaries and clients as to what sustainability preferences they really have. And I think the last point I wanted to make here is it's also a little bit more than just the language problem. I think what we as an industry also have to talk much, much more about is the fact that ESG and sustainability as well, both of these facets, are different when you talk about public and private markets. And I think a lot of the news flow, discussion, also media coverage, a lot of commentators are, in my view, mixing oftentimes private and public markets. Public markets, a long only equity fund, oftentimes, in my view, when it applies certain exclusionary factors, this can be a very, very good means for investors to express their investment beliefs and values and ethics, for example. But through such an investment strategy, you are not generating kind of a positive impact. Impact strategies work very well on the private market side and private equity and private credit, where then for a lot of investors, there are a lot of these investable and also very attractive investment solutions out there. But I think it's important going forward that we try to have this more nuanced discussion about what ESG is, what it is not, what sustainable investing is and what is not, and what the different limitations are in different sleeves of the market, and also think about more specifically what the ultimate sustainability preferences are of your clients and underlying beneficiaries.
Well, that's very comprehensive, embracing both sustainability and impact. And I think you're right. We do have terminology problems, things get lumped in together. One very specific thing that often, say, an institution with many stakeholders will get quite energized on or activated around is stewardship. Could you let us know just where that is now in terms of the level of stewardship, the acceptance of stewardship, the openness of companies to listen to stewardship, and also then this new stewardship code, the burden that can be to be a signatory to the code?
Yeah, so this is a topic that's very close to my heart because this is the topic of shareholder activism, shareholder engagement that I was studying already during my PhD days, when it was a well-known topic then already, yes, but not a lot of investors were kind of thinking about how to conduct their stewardship rights or their ownership rights with the companies that they invest in. A lot of investors were potentially doing proxy voting. Some portfolio managers might have been in touch with the portfolio companies through management conversations, etc. But I think stewardship has evolved into a much, much more thematic and also expert-driven exercise, whereby a lot of underlying environmental, social, and governance issues are being discussed by investors with the underlying management teams and also boards, supervisory boards in the two-tier board system, in order to help companies to kind of position themselves for success over the long run. I think most stewardship activities these days are aiming to help companies to become more competitive and also more successful in the future. What we have seen, however, is also certain pushback, and rightly so, in terms of initiatives potentially asking questions as to how efficient stewardship can be and how successful stewardship can be in terms of promoting change and also bringing about positive change at companies. What I see now, and having worked most recently more on the allocator side, I think from conversations with a lot of asset managers, you nowadays know that a portfolio manager usually has conversations with management teams, especially before making the actual investment decision. It's part of the due diligence these days for most investors, especially when you're a fundamental bottom-up investor. You want to understand who's running the firm. And I think this is oftentimes also forgotten in the stewardship debate. It's these basic conversations that portfolio managers have with management teams as well that are part of stewardship. And my worry nowadays is with this entire backlash against all these topics related to ESG and sustainable investing, I think we see certain backlash also to stewardship. My worry is that portfolio managers might shy away from having these conversations in the due diligence process with managers because they potentially see maybe some sort of litigation risk, etc., if they are having conversations with portfolio companies. But I think this is the most fundamental form of stewardship that, from a fiduciary duty perspective, we as clients or we as investors should expect from the asset managers that we entrust our money with. And I think this is my worry that I'm seeing now, is that potentially investors are shying away from these conversations. When you then turn the whole stewardship debate on its head and approach it from the asset owner perspective, and you refer to the, for example, UK stewardship code, but potentially also stewardship codes in other areas, in other countries, it became quite a hefty reporting burden to a certain extent. And this does not only apply to the stewardship code. I think the entire sustainable or responsible investment community is actually has to a certain extent been turned into kind of a little bit of a reporting department. To a certain extent, it's very helpful, but we should also not forget that oftentimes less reporting is more, in the sense that we can be much, much more concise and very, very transparently say how many meetings did we have with management teams and which topics did we discuss with them in order to promote either positive change at companies or to inform our investment decision. So I think it's going forward will be important to find the right balance between being transparent, not only when it comes to stewardship, but also with respect to sustainable investing, and also getting the reporting right to the extent that the underlying clients and beneficiaries really understand what the investors are doing in order to ensure that the money is actually generated, or the return is actually being generated over the long run for their savings.
And then if you were to look out for the opportunity set that excites you in the near future, I suppose another way of asking the question, what's the next big thing? I'd say from my perspective, I see a lot of nature-based investing. Some of it's maturing, some of it is not proving to be at a critical mass, be sufficient for a scale. But definitely, as net zero commitments remain on the books, they need to be pursued. So that's just one example. But what do you see on the horizon in terms of interesting solutions?
Yeah, so I think you're already referring to the right topic here, which is, in my view, what I would call mega trends of thematic investing. You do not need to be a climate advocate to see that, especially when you take a look at the returns of certain investment products year to date in the renewable energy space, for example, or in the energy transition space, for example, that this is a mega trend and also an investment theme that is remaining. And I think the geopolitical tensions that we have seen this year so far actually have also accelerated this trend. So I think the climate change theme, and then how you define it more specifically, be it the energy transition, for example, or that you, for example, invest in climate transition companies, for example, or enablers of the carbon transition. This is, in my view, still an investable theme that we are going to see in the future. And apart from that, I think there are two big themes that have been already on the horizon for a few years. For various reasons, they were a little bit slow in terms of take up, but I would say nature and biodiversity are, in my view, the next big investment themes or mega trends that we are seeing, especially in my view, again, on the private market side, in private equity or private credit in particular, where companies potentially need these investors to get this capital to be funded actually going forward. It remains to be seen, in my view. We have seen this with a lot of impact products in the past on the public equity side, that they not necessarily kind of generate the impact that a lot of investors are looking for. So I think from a next big thematic perspective speaking, it's really nature and biodiversity, which can also has the potential to generate new forms of investment through, for example, public-private partnerships or blended finance more specifically. It's really hard to make a judgment call in terms of how long this will take or until we reach the scale. I think the entire impact space is still grappling with the question, when are we going to reach the necessary scale to tackle the world's problems? But I think for biodiversity and nature, these are definitely the two big topics that we are going to see huge investments in. And of course, this is maybe a little bit further removed from the sustainable investing discussion. I think I'm not telling anyone something new when I say that AI is definitely remains one of the mega trends going forward as well.
I was actually just going to mention AI, but more because I think that hopefully it may free up responsible professionals at firms to actually focus on more salient impact reporting that is actually relevant for the company itself, as opposed to some more rote gathering of stats, which maybe that can be perhaps outsourced to AI. A lot of the reporting today is can be quite repetitive. Maybe AI can certainly help with that, because on the saliency side, it seems like that is a burden that many allocators and firms themselves have to bear.
And it goes further than just the reporting side. I think what AI nowadays can already start helping with is also impact measurement. If you really want to identify what the companies that you or your fund is investing in are doing for society on the environment nowadays with AI and all the big data behind all of that technology, you can nowadays start finding out where companies generate an impact or have maybe even an adverse impact on society, on the environment. And you can potentially even start comparing companies with one another when you are a stock picker, for example. So I think data and the regulation here in Europe at least is moving into that direction for a number of years now with CSRD and other kind of sustainability focused regulation. I think data is important so that we can actually make better investment decisions. And I think AI will definitely play a role there.
I'm just returning to some personal reflections now. So I think in the description you mentioned some mentorship. I'd love to hear if there were any particular people who had an influence on you. And this does not have to be an exhaustive list, but I'm also thinking of some of the profound thinkers in this space and thought leaders that have an effect on all of us. Any group that you can mention there?
I mean, we have to think about me as coming from a small town in Germany, in rural Germany, outside of Cologne. I think first and foremost, I think my thinking in that regard has been shaped definitely by my parents, from whom I have learned, in my view, the right values and who made it possible for me to actually study in the first place. And I think this is a huge privilege when I think back that I'm coming from a non-academic household, basically. My parents worked really, really hard to kind of give me the opportunity to work in this space and also do maybe something more than just focusing on financial outcomes or financial wealth generation, for example. So this is maybe more on a personal side. And when I then look broader in terms of the big thinkers that have shaped maybe my thinking, is clearly my PhD supervisor, Professor Rob Bauer, who was back in the day one of the very, very first people who had the courage, I would say, in the finance space to start conducting research in the space of shareholder engagement, responsible investing, and helped introduce a kind of a new concept in empirical asset pricing, for example, as a research field. When I started the PhD, I remember there were hardly any kind of papers being published in highly acknowledged academic journals, especially not in financial economics, for example. And he actually helped shape this field, I must say. And I feel really thankful to him, and also still I'm very grateful to call him my mentor, as I said before. And he's still very, very much at the forefront of also thinking about how can we turn this into more actionable elements for example, pension funds. Investor democracy is for him the next big topic, such as I alluded to beforehand, finding out what the actual sustainability preferences of underlying beneficiaries are. And I think what I'm really pleased to see is that this research community in the academic arena has grown since then so much. So you have a lot of big thinkers out there that are nowadays talking and also doing a lot of highly relevant and highly interesting research in the space, such as, for example, Alex Edmonds at London Business School, for example, who also has contributed significantly to the much more nuanced discussion that we need to have about ESG and responsible investing.
A very early guest on this podcast, actually, Alex, before he'd written his recent book. The recent one was about the Growing the Pie book, but definitely very thought-provoking and provocative in general posts, which I think is so important to generate debate here. My last question is around any advice you would have for your younger self. So maybe for that boy emerging from a rural area near Cologne, a place where I have actually spent some of my summers working as a student. Great place to come from, but clearly not a financial metropolis. It'd be great to hear anything you would have wished you had known then that you know now.
That's actually a very tough question when I have to think about what would be the specific advice. I think when I think back now over the last 14 years here in London, for example, I would say that, especially when I think back in terms of what would I have liked to know when I was doing my A levels or even during the PhD, to be honest, is this famous saying, work hard, play hard. But I would actually kind of change this a little bit in the sense that, yes, Michael, you can work hard, but don't forget to actually also have fun and also play hard. And this is something that only over the last few years, actually, that I've embraced and learned myself, because in finance or in such a very highly competitive environment, such as London, you might forget sometimes this play part a little bit. One sentence that kind of summarizes this really, really nicely for me, as it sounds really, really like a big thing, but it's a very nice guiding post nowadays in a sense that you should think about success without fulfillment is the absolute failure. And I think bringing this a little bit together and also enjoy happy moments much more and in a much more immersive way is hugely important, which is also the reason why I've taken out a little bit of a break from the private sector for a few months or maybe a year to also refocus on what's really important in life.
Well, thank you, Michael. That work you're doing is all for the benefit of the rest of us because it does enrich what we think about when we think about sustainable investing. And I think you're right. This focus on fulfillment has always been, I think, what the sustainable investment experts have brought to this table. It is such a way of broadening out what we do within finance, how we think about our impact, how we think about our scope and our potential, and really our role in the ecosystem. So thank you so much for continuing to spark this debate and bring your insights to this podcast.
Thank you very much for having me, Ethan.
I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.